Hey folks, welcome back to Money and Politics. So good for you to join me, and I hope you had a great weekend. I'm coming to you a little late tonight, and so I didn't want to not come since I didn't get something to you on Friday. So I'm going to make this, try to make it short because like I said, I'm coming to you late. That said, let me look real quick just at some of the market action. And while the markets were up today, Humble was, I would say, just kind of, as you can see, pretty doggone choppy and didn't really do anything. And because of that, I wanted to talk about a couple of other things. I will, let me just, while I'm at it, take a look. Here's InMode that I talked about, I think, on Thursday. It had been down over the last 5 days and kind of recovered today a bit. I still like this, and I look at this as a buying opportunity. On Humble, it's been, this is today. Let's go to a 5-day chart. Let's go to a 1-month chart. You see the volatility, and 6 months. So we've talked about this so many times that I think it is what it is. We're just waiting for some developments. We've had the developments in so many of the things that they're doing. It'll be interesting to see if we get any news about anything that's happened down in Chile, in Santiago, while Brian Foote was down there. As we take a look at Zynex, this is another one that could be quite a go up. It has, let's look at the 1-month chart here. And as you can see, it was up, bounced up from about $10. I have to lean in to see that too. About $15.50, and that was in the middle of November. So we're not down to $10 here, but we did kind of come down over the last several days. If we go to the 5-day chart, you can see we were, what is that, $13 a little. So I would say this is something I think, again, it's a fairly relatively cheap priced stock. It's not triple digits. It's fair value down in the lower left, as you can see, and they're the ones that have added so many more salespeople for their device to treat pain with radio waves and all. Now, one of the things, as you well know, is that my channel is called Money and Politics. And so I wanted to talk a little bit about politics because I spend a lot of time on politics during the course of my other coverage and during the day. And if you were a business person and I was in the consulting business, you might hire me to come in and kind of run through what things could go wrong and what things can go right. So I wanted to do that for you tonight. Kind of give you the big picture as we are here in December. Typically, December is kind of a quiet period. So there's a number of things brewing, and I wanted to kind of put them in the context. So let's take a look at that. What could go wrong with the overall market? So I'm not talking about Humble here. I'm talking about the overall market. Well, as we can see, China, which has been growing militarily and doing a lot of things that are very provocative, could attack Taiwan. That would be a very bad thing for the overall market. And one thing I want to put in context, what I'm saying here is not just things could go wrong, but they could go really wrong. And we have to be aware of that. And so you want to be heads up and say, if the you-know-what hits the fan, if it goes really bad, am I in a position financially for that situation? So China could attack Taiwan. They've been doing flyovers over Taiwan, very provocative. Putin is building up over 100,000 troops right now on the Ukrainian border. And by the way, I know a number of you people, it's not that you're not smart. Some of you follow politics and world events, others don't. So I wanted to bring this to your attention. Some things that I'm on my mind behind the scenes, and I rarely kind of talk about the political situation, but it's worth talking about. So Putin invading Ukraine, I would say, is not as big of a deal as China. If China attacks Taiwan, that would be a really big deal. That would be a major political problem. Putin invading Ukraine, again, a big problem, but nowhere near as big as China attacking Taiwan. Iran, in my estimation, a bunch of crazy people within their government. The interesting thing about Iran is that so many of the younger people, and something like 75%, I haven't heard the statistic recently, but it's something like 75% of the Iranian population is below the age of 35 or so. It's a very young country, and a lot of these younger people are more favorable to do something with the West, but they have as you know, a tyrannical government, and they are trying to develop nuclear weapons. That would be a major problem. And the United States would have to respond, as well as, if not Israel in our stead, would respond militarily. So you have the first three things here could lead to war. China invading Taiwan could lead to war. Probably not Putin invading Ukraine. We would apply sanctions, however. That could also drive up the price of oil. All of those first three could really drive up the price of oil, which would be bad for the world economy. And it would be bad, therefore, for the stock market. I'm not putting stocks above, the threat of nuclear war, but I'm talking on an investment channel here, so I want to give you a heads up of what could go wrong that we need to be aware of. A terrorist attack like 9/11, something that just comes out of the blue could happen. And this is why I always say you want to carry maybe 8 to 10% of your portfolio in cash, because not only can things happen where it's like China that we've been following and it's a situation that's developing, but something could happen out of the blue. What else could go wrong besides terrorism and the rest? Well, rising interest rates. We know interest rates are going to rise. The question is, will the Fed act in time to keep inflation in check? And if they will start raising rates and do so in a way that doesn't totally destroy the business environment on a global scale, then that wouldn't necessarily be bad. But rising interest rates, the threat is now that we could have an American economy that boils over and we get high inflation, and we go back to where we were about 40 years ago when, as I may have mentioned, when I bought my first house back in 1981, my mortgage was 15.5% interest. And the only way that the economy cooled down from that was that Paul Volcker, who was then the head of the Federal Reserve, brought interest rates sky high, close to 20% in interest rates, and raised the price of money so that the economy slowed down. Well, that was very bad for the stock market, but it was the right medicine so that we didn't end up having hyperinflation, as we see that they have down in Argentina right now, as they had in Germany right after World War I, again, because of so much government spending. In that case, the Germans were told by the victors of World War I that the Germans were going to have to pay for all the damages of World War I. Well, that was a stupid thing. It was impossible for any one country to do that. So the Germans just printed so much money, they devalued their currency, and the purchasing power of the German mark was nothing. And the fear is that America is overheating our economy, that we're spending way too much, in part because of monetary policy, with the Fed keeping interest rates too low, in part because of fiscal policy, with the government, the Biden administration looking to spend these trillions of dollars. And that bill is now in the U.S. Senate. I would say, in my estimation, there's a very good chance that the Biden does not get the billion, I think 1.7 trillion, rather, $1.7 trillion passed. Either nothing passes because it'll be blocked, or it is negotiated to where it is a much smaller bill and more focused. So, but this is a concern with the whole environment of interest rates. And if they have to go up high, like 10% or more, that would, in the next 2-3 years, really be bad for the overall economy and therefore the stock market. And then the problem could be that we keep getting the variant of the week, it seems like, where we thought that the economy would have been opening up by now. It seems like we keep going to lockdown after lockdown after lockdown, not just in the United States. We talk about the difference between states like Texas and Florida, which are relatively open, as compared to Illinois and New York and California and some others, which are more, Michigan, far more heavy-handed in their lockdowns and clamping down on the economy. So if we can, so that's a problem. Are we going to be able to open up? And we look at Australia as very clamped down. You look at Europe as very clamped down. I had thought, and I think a lot of people, that we were going to have a much more open global economy. So here we are at the end of 2021, 2 full years virtually now on a lockdown that we had initially thought was going to last 2 weeks. So if that's the situation of what could go wrong, then the question is, maybe we should stop being afraid of what could go wrong and start being excited about what could go right. Well, what could go right? Well, what could go right is that China doesn't attack Taiwan, that Putin doesn't invade Ukraine, that Iran doesn't do anything stupid, that terrorism doesn't happen, that interest rates do go up, but they rise modestly, and that is enough to stem the threat of inflation as we go forward, so that the price of groceries, the price of gasoline, and the rest, while it is up, it doesn't go up so much that it kills the growth of the economy. And not even the growth of the economy, the threat would be that we would go into a recession. What else could go right? Well, the COVID lockdowns end. And then we would get that global recovery that we thought, at least I thought, we were going to have already. If that happens, if these things happen, one of the areas you want to pay attention to are the hospitality sector of the economy. Back in the summer of 2020, I was telling friends to buy, and actually in the spring to summer, I was telling them to buy a Norwegian cruise line. NCLH is the symbol. And it was about $16. And I said, my target is about $28 or $30. Well, we were buying at 16. It went up to 28. It actually went up to about 30 briefly. But, to go up to 28, you're picking up $12 on a $16 buy. That was a 75% move. And it took longer than I anticipated, but it did go up there in the early part of this year, because after we got the vaccine, the idea was, well, we're going to open. And then, of course, we know what's happened. Well, just the other day, Norwegian cruise lines that I was telling people to buy at $16, again, back in the spring and summer of 2020. Let me bring that up. Just the other day, I was shocked to see that it had come all the way back down to $18. And right now, it is at $20, went up $1.74 today. So that's a 10% move. And this is where do I think this could go? You could see just the other day, as you can see, it's down to $18 and so popped up. I did look at this. I would say if you want to take a bit of a risky buy, you could buy it here. I would put a price target of $25. So if you bought at 20 and you went to $25, you picked up $5. That's a 25% move. So I wouldn't necessarily hold it long term. Or what I might do is, let me get the year to date. You can see how volatile this is, and we were at back in May at $32. So, if you want to hold on to $32 or the upper or north of 25, someplace between $25 and $30, I think you could get that within a year. And again, there is some risk assigned to this, so don't go crazy selling the farm and your kids' retirement or your college funds, to put it in here. But this is the kind of thing where if we can avoid this permanent lockdown, and the lockdowns would end, then the whole hospitality industry is going to be benefiting as well as some others. Now that said, then we get the global recovery, as I say here, down at the bottom. So, folks, I wanted to put this into context because I think this is the kind of thing that if you got to be looking at the overall situation when you're investing, and what could go wrong, what could go right, but we want to hope for the best but plan for the worst. And so we're going to plan for the worst by doing what? Well, we're going to plan for the worst by, as I often have said, building up your cash position so that if we do get a downturn, you'll have cash on the sidelines. So if you have some winners, go ahead and sell some shares on the winners, and or just put some money in cash instead of putting it back into the market. Again, building cash is one thing. The other thing is, I mentioned the other day that the SQQQ, that S is like for shorting the market. The SQQQ, this is the opposite of the TQQ. As you see here, $6.66. The 52-week low is $5.69. So it has a low in the last 52 weeks of $5, and we'll call it 70 cents. And it's been as high as almost $18, $17.87. So right here, this is like an insurance policy if the market crash. So that's one thing you could do. Would I put a boatload of money into the SQQQ? No, I wouldn't. But I would use it as a hedge against a downturn. Some of these downturns could be short-lived. Some of them could be long. If we had something like China attack Taiwan, that would be a severe downturn that could last for a while. Putin invading Ukraine would probably knock the market down, but I don't think it would knock it down for a prolonged period of time. I think it would be somewhat of more of an irritation to the global economy. I hate to minimize that, but the concern there would be, I don't think that it goes to a larger war, but that it would drive up the price of oil. People don't like political instability. If China were to attack Taiwan, that would be a horrible, horrible thing, because we could actually go to war over that. Australia, the Philippines, Japan, the United States, probably a number of our Western European allies. This is the kind of thing that could, I hate to say, be a world war, but that would be a very, very bad thing if China were to attack Taiwan. I would think it would be a gross a gross miscalculation on the part of the Chinese if they think that there is not going to be a very meaningful response. Well, look, before we go too far off the mark, I'm going to say these are the things that you have to think about. You don't want to be caught flat-footed when you know what hits the fan. You want to have a game plan ahead of time to deal with that. Now, before I close, the other thing, of course, if we can get, for 2021, if we can get Humble to get their revenues up as we're hoping, then all of us who are the Humble stockholders, and we get some good news, certainly at this low price, we could see a dramatic turnaround in our portfolios going forward. Hopefully we maintain that kind of general global stability that we have at the moment. The problem is that so many things that the Biden administration has done over the course of its tenure thus far in this first year have been viewed by a lot of people as being weak and ineffective. They did today announce that they were going to have diplomats from America boycott the Chinese the Olympics in China. So that's something, but a lot of people, even on that, thought it might be a little feckless. If China were to invade Taiwan, speaking of the Olympics, I think we would be safe until after the Olympics happened in China, which I think that means that we would be after February. So we are probably good at least for the next 2 months on that score. Putin going into Ukraine, nobody knows what he's doing here. He has been building up his troop strength along the Ukrainian border. So, folks, you might remember the other day when I showed you the 50-year chart of the S&P 500, and we had a number of bad things happen over those 50 years. So things are going to happen. They're going to go wrong. There's going to be political turmoil from time to time. The message tonight is have a game plan. Don't wait and wish you had built up your cash reserves. Take some money off the table with some of the stocks you have that are profitable. If you got spare change, put some money, instead of buying more stocks, maybe just park some money in your cash account. And if something does go wrong, then you'll have the cash to either weather the storm or to go in and buy some of these stocks at a cheaper price. If nothing goes wrong and you built up your cash account, well, then you got the cash on hand to continue to do buying of stocks and opportunities as they come along. Okay, folks, I'll say good night for now. If you haven't, I didn't put my little thing up. If you want to read me, or write me rather, an email, there you can do it. If you want to follow me on Twitter, you can do that. And for now, I'll say good night.